Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. The U.S. president is threatening to completely wipe out the country of Iran. In a post on Truth Social, Trump says Iran civilization will die tonight unless the country strikes a deal in what he called one of the most important moments in the history of the world. Trump has set a deadline for that deal to be reached by 8 p.m. Eastern Time. The Prime Minister, Mark Carney, is urging against all targeting of civilian infrastructure in Iran. He says countries involved in the war should respect international law and rules of engagement. Carney also says Ottawa is looking at ways to cushion the blow of higher gas prices pushed up by that conflict. Home prices in Canada's largest city fell to their lowest level in more than 5 years. Data coming in from the Toronto Regional Real Estate Board shows the benchmark price of a home in Toronto dropped 0.6% in March compared to the month before, the lowest it's been since December of 2020. Now, the supply of listings remains elevated, and on the upside, the number of homes being sold in March increased for the first time in 6 months. First Quantum Minerals says Panama's government has given it the green light to process stockpiled ore at its Cobra Panama mine. The Canadian miner will process about 38 million tons of ore and plans to expand its workforce from current levels to 3,000 employees. First Quantum says it expects preparation to take 3 months and it will require about $250 million in capital. Here is where we stand on the day. The TSX Composite down 42 points right now, 0.1% to 33,138. Let's go south of the border. The S&P 500 down about 0.4%. The Dow down almost 0.5%, 211-point drop. And the Nasdaq down about 0.5% at 115-point drop so far on the day. Canadian stocks are sliding or North American stocks are sliding with the U.S. President Donald Trump dialing up the tough talk against Iran. Our next guest says some concerns will persist even after the conflict winds down. For more on his defense strategy, let's go to Colin Stewart, CEO and portfolio manager at J.C. Clark. Thanks for joining us today.
No problem, Marella.
What do you do with this kind of doomsday language by the American president? I mean, most investors know not to try not to react, but it's pretty hard not to.
Yeah, I mean, obviously in the short term, I think it's very difficult. It's a bit of a binary outcome. I mean, I think if there's a near-term off-ramp and clearly that, Trump wants some kind of an off-ramp here, we believe. And so if there is a short-term ceasefire or settlement, the likely outcome would be lower oil prices and a short-term rally in the market. But, in our view, there are other sort of problems, other things to worry about, slowing economic growth, potential inflation. Data recently has been moving upwards. Valuations in the market, particularly in the U.S. equity market, are still relatively high. So our general view right now is for investors to maintain a fairly defensive positioning. And, that's the way we've been positioned for our clients at J.C. Clark. And I think also focusing in on high quality businesses.
Okay, let's talk about the price of oil. We'll see if we can bring up the chart as well. It rose again today after the remarks by Donald Trump. How much of the climb do you think could remain if the conflict does end? And what do you see as the longer economic impact here?
Yeah, I mean, there's no doubt. I mean, very similar to what we saw with the Russia-Ukraine conflict, which has obviously been ongoing for some time now, that anytime there's war or conflict, it tends to be inflationary. So even if this were to some kind of a ceasefire were to come to pass here with the U.S. and Iran, I think there are some lasting impacts. It's not clear that the Strait of Hormuz will open immediately. It might be slow to open. Higher energy prices are likely to flow through to various economies globally, even to the U.S. economy, and here in Canada with higher gas prices. I think consumer sentiment potentially weakening when there's conflict ongoing. So, there are some lasting impacts, but I think generally wars and conflict tend to be inflationary. So I think that is a near-term risk, and perhaps one of the reasons we've seen bonds selling off and bond yields moving upwards in recent weeks.
All right, Colin, let's talk about outside of the price of oil. How do you see the market doing, and is there a defensive strategy that you're working with?
Yeah, I mean, I think the market is, here in Canada is held up somewhat better than in the US. I think valuations are a bit cheaper. We obviously have sectors like precious metals and energy, which tend to respond well in inflationary periods. And I do think the valuations in the Canadian equity market are cheaper. So our view is to favor Canada over the US from a geographic standpoint. But again, as I said earlier, just focusing on quality businesses, there are, because of the conflict in Iran and AI disruption fears, there has been a lot of dislocation in the market in the last few months, and we've seen certain sectors like software, for example, sell off significantly. So I think there are some opportunities perhaps in the tech space, and also just with generally high quality businesses. We think the defense and aerospace sector is another area that's going to continue to benefit from this, significant increase in spending in Canada and by a number of NATO countries to spend more on defense, given what we've seen going on around the world. So those are some of the areas that we're focused on right now.
Okay, let's get to a couple of your stock picks. Black Diamond in the first one, that stock has doubled over the past year. Tell us about what they do.
Yeah, so they have two businesses. The main one is a modular space business. So they effectively provide sort of portable units for infrastructure projects. You might see on the side of a highway, these metal units set up as offices for construction sites, things like that. They also rent those units in the mining sector for infrastructure, defense applications. So and even, for example, in the education sector, providing portable units for schools in Canada and the US. So that's a very good business, very steady cash flow driven rental income type of business. It's been growing very nicely over the last number of years. They have pricing power, so they've been able to raise those rental rates. And then Black Diamond also has it's called the Workforce Solutions business, effectively the old camps business that used to provide housing for a lot of the big oil sands projects and what have you. And now some of those units are being repurposed for things like growing, infrastructure and defense projects in the north, LNG projects, things like that. And with the huge increase we're seeing in defense spending in Canada and the focus on the government of developing the Arctic and protecting the north, we think that Black Diamond is really well positioned to, see increased utilization in those camp assets. The company has a pretty attractive valuation at about 7.5 times enterprise value to EBITDA. And they also have a really strong management team. So even though the stock has gone up nicely over the last year, we think there's still a lot of upside in the future.
Okay, let's get to another pick, which is Thomson Reuters. They have dropped off significantly in recent months. I'm wondering why software concerns haven't dialed down yet.
Yeah, I mean, the whole software sector has been under pressure, just this fear of AI disruption. Thomson Reuters in particular sells software to corporate tax accounting customers and has a huge software business in the legal industry. And there's a lot of concern with some of these new AI applications that they could disrupt that. We think that concern is overblown. I mean, Thomson Reuters has a very diversified customer base, over 500,000 customers, about 80% recurring revenue. They're integrating AI into their software, and I think are frankly going to benefit in some ways from AI. So interestingly, despite the very significant decline in the share price, the company came out a few months ago and actually upped their financial outlook or increased their financial outlook for 2026. So we think the financial results and performance of the business continues to be very strong. And with the share price having declined so significantly, the valuation is now down to, value investor territory. I mean, we would have never owned the stock at, previous levels when it was trading at 25 or 30 times EBITDA, but it's now trading at only 12 or 13 times EBITDA, pays over a 3% dividend yield. So this is for a very high quality business, almost unheard of valuation lows. So we think there's a good opportunity for investors because of that disruption to consider a potential new investment in Thomson Reuters.
All right, something for investors to think about. Colin Stewart, I appreciate your time, sir. Thanks for joining us today.
Thanks, Marilla.
Coming up, are we looking at $200 barrels of oil if Trump follows through tonight on his threats with Iran? Back in a moment. The U.S. President Donald Trump threatened to wipe out Iran if it doesn't make a deal by 8 p.m. tonight. For more on this and the oil markets, we spoke with Clay Siegel, Senior Fellow, Center for Strategic and International Studies.
I think that the brinksmanship is certainly at an all-time high since this war started in late February. But the stakes are really high for the energy market in particular, and from that, the global economy. Because if we have a sustained period of very high oil prices, that's going to proliferate through other parts of the macroeconomy. You know, consumers are going to have to pay more, and they're going to be less likely to spend on other stuff. Businesses are going to have to pay more to move goods from factory and port to market and to people's doorstep for substantially everything that households buy. So we're going to see higher prices proliferate through the economy, and that could result in an economic slowdown, GDP coming in lower than forecasted before the war, and potentially even a rise in general price inflation. But in the energy market in particular, we have to be concerned about demand destruction, or at least demand curtailment. And so even for oil producers that tend to do better along with somewhat higher prices, you can have too much of a good thing. And we've seen in past oil price spike episodes that prices got so high that consumers and businesses pulled back on demand. And that's not good for oil companies either. They prefer a steady state of sustainable prices for the medium and long term.
It's kind of not bad for the environment and other things. I mean, there could be some positives when it comes to that. How, with these soaring prices, are we talking recession if it continues? If this deadline comes and the end of the world is launched on Iran, as Trump was threatening, will that lead to a recession if this war drags on?
The end of the world, as you put it, does sound bearish for financials generally. But I would say away from today's tactical deadline, and who knows what's going to be in effect by this time tomorrow, the bigger picture here that companies need to plan for is medium-term instability for energy exports from the Gulf. We were receiving about 15 million barrels per day to world markets of crude oil from the Mideast Gulf before the war, and that's down to just about 6 million barrels per day. So we've lost 9, we've lost 60% of what was coming before. And the world oil market can't live, at least at the same size as before, without that flow of oil from the Gulf. And gas is important too. So 10 billion cubic feet of liquefied natural gas, primarily from Qatar, some of which is going to be offline, apparently, according to Qatar Energy, for a period of years. Where I'm going with all this is the world market needs that supply from the Gulf. There's no way that supply-side adjustments can compensate for that size outage. And so the only coping mechanism for the market is to shrink if we have sustained high oil prices, and that's going to mean a downturn in demand. And that's what translates to the lower GDP that I was alluding to before.
And now we're seeing it, of course, in Asia. They're having to pull back. They're rationing. Europe could be next. Could that come to North America? I know we're considered an oil country in Canada and an oil exporter in the U.S. Could it come to us, though, as well? Could it hit us?
Yeah, certainly it will hit us in some capacity. It's true that here in North America, we are somewhat indemnified from the global effects because, of course, we are long crude oil and, in the case of the United States, at least, refined products. We're exporters to the world. But it's a global commodity and a largely fungible commodity. And that means that a disruption anywhere affects prices everywhere. And you've already seen headlines as recently as this morning that North American crude oil prices are starting to get pulled higher, even though there's no sign of a physical shortage in this part of the world yet. That's just simple global arbitrage. When you start to get higher prices in Asia, that's going to pull more crude oil from west like in the Atlantic Basin, toward those east of Suez markets. This is how efficient markets function, and we're seeing it again in the case of this disruption.
This adjustment, how can you see Canada benefiting from this, or will they?
Well, when we talk about benefit, you have to think about the time horizon. And the way these price spikes have gone in the past is, of course, higher oil prices, which is the product that producers sell, can be beneficial for earnings in the short term. But if the secondary effect is for a pullback in demand and potentially even permanent demand destruction in some cases, and I think you alluded to the environment and maybe potentially the sale of additional electric vehicles, and in other words, some segment of the transportation industry retiring conventional engines and switching to renewables, that has the potential for longer-term effects to have lower prices. We have to see how all this shakes out for regional balances before we can really call prices, though.
And could this drive the electric vehicle market? I mean, we've seen the rebates and everything disappear in a lot of places, but the 73 oil shock drove a lot of people towards smaller cars. Could this be a tipping point for electric vehicles as well?
Yeah, I think it's definitely possible. If you run something like 6 to 12 months of really elevated gasoline prices, I do think that that's constructive for the EV sales trajectory. But longer term, when we talk about effects on the environment, I mean, you can say that it all adds up, and I think that that's true, even on an incremental basis. But you got to remember, it takes many, many years, even more than a decade, to put a significant dent in the stock, the composition of the vehicle fleet that's out on the road. And so even if you had a change in new sale patterns over a period of 6, 12 months, that's probably not enough uptake into the stock of the total fleet that's out there on the roads to really make that big of a difference, moving the needle for greenhouse gas emissions and environmental consequences.
Clay Siegel, Center for Strategic and International Studies. Up next, what the Prime Minister had to say about those new threats by Trump. Back in a moment.
Canada expects all parties in this conflict, in any conflict, to respect international laws, the rules of engagement, and that means not targeting certainly civilians or civilian infrastructure. And we urge all parties in this war to follow those responsibilities. It's a point we've made publicly and privately.
The Prime Minister there responding to U.S. President Donald Trump saying a whole civilization will die tonight if Iran doesn't reopen the Strait of Hormuz. For more on the Prime Minister's comments, we will go to Bloomberg's Brian Platt. He joins us now. Brian, the Prime Minister, we know, is always very diplomatic about things. We've seen him carefully tread around rhetoric in the past from Donald Trump. What more did he have to say about this?
Yeah, I mean, that was the clip that you just played is pretty much the extent of it. He had a very careful choice of words, very moderate choice of words, calling on all sides not to hit civilian infrastructure. I mean, the Prime Minister's in a difficult position here because, Canada just doesn't have much influence over the events. And Canada is just one of many, many countries that has to react to events right now. To the extent that Canada is a member of the G7 or NATO or as a country that often emphasizes diplomacy can help encourage those efforts. I think that's what Carney is trying to do. But for the most part, he just has to tread carefully because, coming out and also strongly attacking or condemning the president can just cause the president to turn his backlash onto Canada. And so I think that's what you saw today when Carney was asked about this.
Yeah, and there's a Kuzma review we know pending. The Foreign Minister, Anita Anand, also spoke about this. Were her remarks in line with Mark Carney's?
Yeah, it was basically the same thing. I mean, urging not to hit civilian infrastructure. So that's aimed obviously at what President Trump is threatening. It's also aimed at Iran, which continues to lob missiles at gas and oil infrastructure in the region and sometimes at airports in the region. All of this is obviously having a a really bad effect on energy markets, and that's where you start to really see this come back in Canada, as it does in every country, with the price of gas going up and up.
Yeah, the Prime Minister did suggest, of course, that he's looking at ways to help Canadians out on that front. We've seen the price of oil beginning to moderate after an attempt by Pakistan in the last hour to try and intervene here. But tell us more about gas prices and what we could expect from the Prime Minister. Was he specific?
So the Carney was pretty vague about this when he spoke about it today. He said, the question is how long the Strait of Hormuz may stay closed or largely closed, and then what the effect of gas prices would be. And with gas prices going up and up, he said that's the government's focus right now, is the effect that that's having on Canadians, and what steps could be taken is something the government is considering. So that's as far as he went. We know the Conservative Party leader, Pierre Poilievre, called for all federal gas taxes to be suspended. I no doubt that's something that the federal government is looking at. We know sometimes they do this also through topping up a GST rebate check, or sort of like some kind of broader fiscal stimulus measure to put more money back into people's pockets. But every time somebody fills up the gas tank, they see this, right? And so that plays out politically, and I'm sure the cabinet is looking very closely. It's hard to know what else you could do directly on gas prices beyond suspending gas tax. So I'm sure that's one of the options that they're very closely considering.
All right. Brian Platt is with Bloomberg. Brian, thanks for the update. Now, as the U.S. deepens that involvement in the Middle East, the cost of fighting is also climbing, drawing criticism from lawmakers. Bloomberg's Shaquille Omari explains how much the war could cost American taxpayers.
From a barrage of strikes to more troops on the ground, growing tensions in the Middle East are leaving American taxpayers to foot the bill. Some critics not in favor of President Trump's decisions.
He took us into this war in Iran without a clear plan, and it's costing us billions of dollars a day.
To date, the conflict has cost more than $25 billion a week, $11 billion spent just in the first 6 days. With troops on the ground, Bloomberg analysts estimate costs could climb between $15 and $20 billion a month. For perspective, Operation Iraqi Freedom carried a lower monthly cost, between $8 and $15 billion. Total cost topped $806 billion, according to data from the Center for American Progress. Occupying Iran's Karg Island could drive monthly expenses up $10 billion more, costing up to $30 billion a month. To cover further expenses, the Pentagon is planning to ask Congress for $200 billion.
As far as $200 billion, I think that number could move, obviously. It takes money to kill bad guys.
President Trump says he predicts ending the war on Iran within 2 to 3 weeks. The U.S. defense officials say the key details about U.S. military spending, including planned budgets for services, will be released on April 21st. Shaquille Omari, Bloomberg News.
Coming up next, the closing bells on Bay Street and Wall Street. Here are the closing bells for the end of the trading day. At the NASDAQ, SS&C Technologies ringing the bell. In New York, Voya Financial doing the honors. You're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. TSX today gaining 55 points to end the day up at 33,237. The S&P, and not a lot of movement. It gained 5 points to end the day. And the NASDAQ up 21 points or a 0.1%. We are keeping track of the price of oil, which has been spiking, of course, with the conflict in Iran. It is up at $112 at this hour. This is West Texas, of course, May contract. So it's down a little on the day, but that's because Pakistan is now trying to intervene in the conflict on behalf of Iran to get more time and push a deadline for the U.S., which is 8 p.m. tonight, is what Donald Trump set out. So we're watching the price of oil. We'll keep an eye on that. Let's get to movers in Toronto. Keel Infrastructure is losing today 4.8% or 14 cents a share. taking the price to $285. Go Easy, the lender, which has been troubled by some write-downs, has dropped another 6.6% or $2.32, taking that price to $32.79. Cureleaf is also down today over 7%, 7.7%, so 26 cents loss per share to $3.13. On the flip side, moving up today is International Petroleum. It gained over 4% or $1.56, and it's up 122% over the last year. Methanex, also a gainer today. It's up 3.4% or $2.93 to $88.58. And then Wesdome Gold also up today. It gained 6.8%, $1.81 per share. So while the markets have been watching the Middle East, there were some deals that were moving stocks. Let's go to Ross Gerber, President and CEO of Gerber Kawasaki Wealth and Investment Management. Thanks for joining us today.
My pleasure.
So Intel jumped today after saying it's going to join Elon Musk's Terafab AI project. What are they going to do, and is this a catalyst for Intel?
Well, it takes a long time to build a chip factory, and we're just talking about it, and they also have to raise the money for it. So there's a lot of steps between Elon Musk saying something and it actually becoming a real thing. And, like many of these projects, we're just not sure if they'll ever be completed because I've got about 6 other Elon Musk projects that aren't complete as we speak. So I think it's good news in general because we do need more chips and more fabrication. And it's certainly good news for Intel that somebody wants to partner with them. But I just don't make anything of announcements. We need real chips and we need real results and things that'll happen the next year or two, and that's not on the agenda with this.
Okay, so let's get to the Broadcom deal. It's going to make AI chips for Google and Anthropic. That sent the stock up. Do you see a lot more of this kind of circular deal making?
Well, in essence, they all have a lot of incentive to work together because they all benefit from the success of AI. So yeah, I do think we'll see this continuous cycle of investment and reinvestment into new products and technologies that are being developed through AI, database systems that they're building. So this is just a continuation of the large investment Google's making into building out their AI infrastructure and making it, obviously chips that are unique to Google's uses. So this is, it's nothing but good news for these companies as they, especially Anthropic, which has made a wonderful product out of Claude, and the demand is off the chart. So, they're going to be buying chips and building data centers for a long time to come.
Okay, let's get to this interesting suggestion. Activist investor Pershing Square's offer to buy Universal Music. So tell me what you think about the offer and also the value that could be there.
Well, Ackman, actually similar to myself, has a background in music, and he's, I don't know if he still plays music, but I know he did in the past. So he has a affinity towards music. But I've spent actually a lot of time actually in the music industry, and I can tell you that it is probably the hardest place to make money. And these publishing companies like Universal and Sony, they have these assets that generate, a reoccurring revenue stream from the songs that are generated. And there's a lot of value in, classic songs and the revenue streams they generate, but it's very quantifiable. So paying a premium for a business like Universal, I just don't see where the upside is. So I'm not necessarily saying it's a bad idea because there's only 3 players in this market, but music's changed a lot, and the way young people interact with entertainment has changed a lot. And where music will be in 5 years, I think is going to be much more dominated by live experiences than by recorded music, which will still generate revenue streams, but it's possible that they won't be as high as many people expect.
Interesting. Okay. What is your take on how the markets are reacting to the new threat to basically eliminate Iran from Donald Trump?
Well, the Persian Empire has been around, for thousands of years, and Donald Trump is not going to end that. Certainly Alexander the Great tried and did not. So, Trump, the not so great, is certainly not going to defeat the Persian Empire. So I think all this hyperbole is Trump's attempt to force the Iranians to the table to make a deal because things aren't going in the timelines that he had hoped. But, the truth of the matter is, more violence and more attacks on Iran isn't going to change their, insistence on especially their pride and what they believe is their right to control their own destiny. So they've never surrendered in 5,000 plus years, and I'm a Jewish guy, so we have a long history with the Persian Empire, and I can say that this is probably going to go on for some time and be a difficult thing to resolve. And markets, I think, are I wouldn't say wrongfully, but probably a little bit overly optimistic that this is going to end quickly and in a manner that isn't economically damaging. So I'm not sure, because I can tell you the worst case scenario and I can tell you the best case scenario. I'm not sure where we're going to fall on this, but I know that if I was president, I would certainly not be handling this conflict this way. So I really just can't tell you the outcome.
Okay, so let's talk a little bit about the broader idea of earnings and growth, because as you mentioned, we don't know what will happen.
That we can quantify.
But
right.
We don't really know how long this conflict will actually drag on for. So most have been still expecting earnings season to be positive. Do you see perhaps revisions coming as we get closer to earnings being released?
This is where it gets tricky, because I don't think people canceled, their vacations or building their data centers or shopping. It was spring break, and I'm in Southern California here, and the weather's perfect, and it's packed with tourists. Packed. And most of them are not international. They're domestic tourists. But people are traveling, and people who you would think would be struggling under the weight of higher gas prices are still spending money. So we still just have not seen the effect of the war on consumers, and many people don't even pay attention to it. So there's a large part of America that probably doesn't even know that we're in a war. It's sad, but true. And so, I actually expect very good numbers for the quarter. I don't know what second quarter and third quarter looks like, but the economy is very strong. So unless this goes on for longer than another quarter, I think that the damage is somewhat measurable and not too bad. But if this continues to go on, inflation continues to soar, rates stay high, this could have an effect on the economy. And maybe it's not this year, maybe it's into next year, but it will have an effect on the economy. And it's an election year in the United States. So there's a lot of factors coming into play here. And I think it's too hard to make a call like sell all your stocks or go all in. So I think the best thing is for what we're doing at our firm is just taking a conservative approach to markets and making sure we're happy with our allocations. So if markets go down 10 or 15% more, one should be ready to pounce and buy stocks. And if markets rally 10 or 15% more, you should be in a position to take advantage of that. And that you can do that by having a balanced portfolio.
Okay, I do want to get to one of your stock picks because I thought it was interesting. It's called First Cash Holdings.
Yeah.
And it's essentially a pawn store chain. Are they doing well? What's going on here?
They're like crushing it. I didn't know anything about the pawn business, and it turns out one of my kids' friends' dad runs a bunch of these pawn stores here in Los Angeles, and I always thought it was about buying and selling junk and arbitraging the difference. And he laughed at me and said, "Let me take you to the store." And this guy taught me how pawn shops work, which are basically micro lending businesses that are based off the collateral that people bring in. And most of the collateral that they bring in is jewelry, and much of it is gold. And so what happens is you have a double whammy. With higher oil prices, more people need money, and it's putting pressure on lower end consumers, lower income people. And so where they get money is not going to be the bank or getting a cash advance. So they have to go to these pawn shops, and then they'll use collateral like their mom's necklace or something like that. And if they don't pay, the pawn shop keeps the collateral. But if they do pay, they're earning interest rates anywhere on the low side of 35% to as high as 100% or more on these loans. So it's a wonderful business with this type of economy and having soaring gold prices. So they're just getting a quadruple whammy of positivity in this business, and we love the business.
All right. I thought that was a really interesting pick there, Ross. Thanks for joining us. Appreciate your time.
Hey, thank you.
Coming up, home sales in the Greater Toronto area seeing a few signs of life. We're back in a moment. We have earnings results coming in from Levi Strauss, well-known maker of denim. First quarter earnings coming in. Investors waiting to see whether the turnaround plan is still going as planned. The company, of course, been facing some tariff pressure and cautious consumers, but last quarter showed momentum beyond just denim. Here's how it looks. Adjusted earnings per share coming in at 42 cents versus 38 cents year over year. The estimate had been 37 cents, so a big beat for them there. Adjusted net income coming in at 167 million. That's up 11% year over year. And the estimate had been well down at 143.9 million. Net revenue, 1.74 billion. That's up 14%. And the estimate was 1.65, so a beat there. Here's the breakdown regionally. So America's revenue coming in at 856, that's million, 9.3% better than last year. And 817.1 million was where they were last year. Europe revenue coming in at 496 million, that's 24% better than year over year. Asia revenue coming in at 347, that's a 13% increase. And then gross margin coming in at 61.9 versus 62.1 year over year. So that's actually a drop. Now the forecast, the adjusted earnings per share coming in, they say 142 to 148. They saw 140 to 146. The estimate had been for 146, which was Bloomberg. And the net revenue coming in 5.5% to 6.5% higher, and 5 to 6% was where they were. Home sales in the Greater Toronto Area showing some early signs of life, with March posting the first year-over-year increase in transactions in 6 months, but prices still going lower. To get more insight on what it means for the market, we were joined by Jason Mercer, Chief Information Officer at the Toronto Regional Real Estate Board.
I think we're starting to see a little bit of response to improved affordability over the past year. So we've seen home prices trending downwards, as well as borrowing costs by and large. And so there's a lot of households that have been on the sidelines that are saying, when I look at that monthly mortgage payment relative to my income, things have improved a lot, and I can also take advantage of substantial negotiating power that's in the market today.
But the broad home price, the benchmark home price, which of course is a very broad measure, there's so many different types of housing, hitting the lowest since late 2020, the price.
Yeah, and I think that's, again, just sort of representative of the choice that many home buyers operating in the market today have experienced over the past year, really couple of years, in the sense that even with sales ticking upwards in March, we're seeing inventory levels, much higher than what we consider normal, whether you're looking at, new listings coming into the marketplace or active listings. And so when you have that kind of choice, that type of negotiating power, that continues to impact price.
It's interesting we haven't seen more of a recovery in price, maybe because we've had quite a lot of interest rate cuts in Canada.
Yeah, and so if we continue to see the trend that we saw in March, where with sales up a little bit and new listings actually trending lower, we'll start to eat into that standing inventory, those active listings that we measure at the end of each month. And so if we see that for a few months, that could provide a little bit of support for pricing as we move into the second half of this year.
Is it the condos? Are they the main source of price weakness?
Well, if you think about where we've seen a lot of the new construction completions over the last couple of years, that's certainly been in that condo space. And so as units have completed, you've seen investors that have been looking potentially to sell. You also have the scenario where during the construction period, you have end users that had every intention of moving into that condo. Perhaps their situation has changed, and so those units get listed for sale as well.
We've heard talk of a condo crisis. I mean, are a lot of units just sitting there with owners who'd like to sell but can't get the price they need?
Yeah, it's interesting. When you think about the new home construction market, and particularly condos, you have some that are pointed at end users. So you have investors that purchase them off of plans and sell them to end users upon completion. But you've also seen a lot of the units pointed at the secondary rental market over the past number of years as well. And so as we've seen, the dynamic shift in terms of temporary migrants and what have you in Canada, that's also impacted the rental market. And so, that's also fueled the number of listings we've seen come online as well, because the prospects on rental haven't been as strong.
In retrospect, was it a mistake to build so many small condos?
Well, I think, when you think about what the formula was in order to get a project off the ground, you needed to see investors purchase those units off of plans and essentially act as wholesalers during the construction period, and then either sell to a retail buyer, an end user, or rent that unit out upon completion. I think certainly moving forward, when we're thinking about the type of housing we need, that sort of missing middle housing, plexes, stacked towns, et cetera, that can bridge bridge a gap between, say, traditional single-family homes and condo apartments, perhaps we need to look at a bit of a different formula in terms of how we underwrite that construction financing and what have you.
Yeah, that model of selling to investors or speculators left us with a lot of very small units.
Yeah, and I mean, we've seen the willingness on the part of the federal government and provincial government to look at, new policies pointed at the new home market. Obviously, we've looked at HST, we've looked at development charges over the last couple of weeks. I think, there's also the opportunity to perhaps look at, where we go in terms of underwriting, especially on the construction financing side. If we're looking to see, development pointed in a certain direction, that could be on high-rise condos of larger units. It could also be, again, on that sort of missing middle type construction, so potentially wood frame construction at that sort of mid-rise level, both in existing neighborhoods and in new developments as well.
Sorry, what was that about wood frame construction?
Yeah, so I mean, if we think about the type of housing we need to see moving forward as construction picks up, again, it's that sort of missing middle, that mid-density type of housing that bridges the gap between condos and single-family homes, and a lot of that we could shift to that sort of wood frame type of construction or even modular construction that sees these units come online much more quickly than, say, high-rise concrete.
Yeah, apparently Mattamy Homes, Peter Gilgan, is all over this. He's very interested in the prefab homes, the modular homes.
And I think it makes sense. Like, as we've seen, the policy shift towards, this type of home construction, I think now we'll start to see innovation in the space as well. What's the best way to bring this online? Is it factory build, modular, truck it to the site, or is it build with traditional wood frame? It's probably some combination thereof.
And I'm not sure that you're not a construction guy as such, but townhomes how do they compare to a semi-detached?
I think, when you look at townhomes, it's a little bit more efficient than building a semi, because you'll have a row of those units, and there's more common walls, and so it just makes that construction of low-rise homes that much more efficient. And then you can also verge into that stacked town category, where it's kind of a hybrid between a townhome and a condominium apartment as well.
And has there been real significant progress on these development charges? I mean, Toronto is notorious. We've heard that it can add $100,000 to the cost of a new home of the various levies from the city.
Well, I think, if you're looking at, the federal and provincial governments sort of taking up the slack on that, and that gets passed through to home buyers in the form of savings, that'll certainly help in terms of, bringing online the type of homes that people need over the long term. And if you think medium term, we haven't seen a lot of pre-construction home sales over the last couple of years. And so that means as we eat into this inventory of resale housing, market conditions could tighten up again unless we start to see home types that can be built a lot quicker come online.
Jason Mercer is the Chief Information Officer, Toronto Regional Real Estate Board. Up next, Trump escalates the warnings against Iran, saying a whole civilization will die tonight unless there's a deal. Back in a moment. The U.S. president says a U.S. president has now issued a death threat essentially to Iran, saying a whole civilization will die tonight if Tehran does not agree to a ceasefire. That's by 8 p.m. Eastern time. Let's go to Arif Lalani on this. He's former Canadian ambassador to several Middle East countries, including Iraq and Jordan. Thanks for joining us today.
Thank you for having me.
What do you make of this threat?
Well, it's kind of beyond belief, isn't it? But you have an American president essentially publicly threatening to commit war crimes against civilians and civilian infrastructure. It's just unprecedented, and it just underlines the point that this war, since its beginning, has been fought on the backs of civilians in Iran, in the Gulf states, and in Israel.
There have been so many threats, so many deadlines that have come and gone. What do you think Washington is not getting about the mentality of the leaders in Iran?
I think it's not Washington. I think it's one person. I mean, what is it that President Trump wishes to do? So I think it's very clear that he has talked himself yet again into a huge escalation with huge consequences. Now, there is always time, there is always room for an agreement or a deal to step back, but it just depends on, what are the incentives and what are the leverages.
Okay, so what do you think it would take to get to a ceasefire agreement from both sides?
Well, I think it just takes motivation. I mean, President Trump has made it clear over and over again that he's perfectly willing to declare victory on an issue and step back. He's done it on a series of tariffs. He did it on Greenland. He more or less has done it on Venezuela. So, he could come back tonight or tomorrow morning and say, the Iranians have agreed that the Strait of Hormuz will be open to certain types of shipping, which is the case. Declare victory. He could say that the Iranians have responded and there's more negotiating to be done. And I hear that perhaps that's where this may end up later tonight or tomorrow. I think the challenge we have is, the countries that would have leverage over the United States right now, Russia and China, do not have an incentive to stop this right now. And the countries that have an incentive to stop it in the Gulf states don't seem to have much leverage.
Doesn't China have an incentive to stop it because they rely on oil coming out of Iraq and have not been able to get any of that or use any of that in the last month?
Well, China has been able to get its oil, and I think this is the thing that needs to be understood. The Strait of Hormuz is closed to American and other shipping, but the Iranians are allowing ships to go through, particularly from China. They're exporting oil to India, and they're charging a higher fee. So in fact, Iran today is exporting about as much oil as it used to before this attack and is making more money.
Okay, so let's talk about what you see happening if there is no ceasefire announcement or some sort of agreement before 8 p.m. tonight, which is Eastern time. What kind of attack do you see Washington, Donald Trump, carrying out if that deadline passes?
Well, I think you've seen the first stages of those attacks already today, where Israeli and American forces have attacked civilian infrastructure in Iran. And there have already been responses from Iran. So I think at the very least, you may see attacks again on universities. The Israeli armed forces have warned Iranians to stay away in Tehran from railroads and metros, indicating that those might be targets. So you may see some of that as the next step.
Ground troops. Do you think those will be sent in either to Iran or some of the islands in the Strait of Hormuz to show American presence?
I think most experts will tell you that the amount of ground troops that are being deployed, which is about 8,000 to the region, can't really do much. Just to give you some perspective, when the Americans went in to liberate Kuwait from Iraq decades ago, it was close to 1 million ground troops from 30 countries. When they went in decades later, in 2003 in Iraq, it was hundreds of thousands of troops. So the idea that 18,000 Marines are going to be able to achieve anything here really isn't realistic.
Okay, what do you think is realistic? You mentioned you're sort of hearing that there may be an announcement of some sort of agreement with more to come.
But I think what would be realistic is to, a deal can be achieved. There is a scenario in which the Iranians would say, well, the Strait of Hormuz is open to a specific set of countries. It would allow the Americans to say that, look, our allies can receive their oil. And all of the other things that were on the table on nuclear enrichment, on stockpiles of enriched materials, all of that can still be negotiated under a ceasefire. So the elements of a deal are there. It's just a matter of whether the president is prepared to take it.
All right, Arif Lalani, sir, got to leave it there. Very much appreciate your time joining us today on The Close.
Thank you.
Coming up next, the new tariffs that Donald Trump imposed are in front of the International Trade Court soon for arguments. We'll talk about that in just a moment. On April 10th, the International Trade Court will hear arguments on the new 10% tariffs Washington introduced after the U.S. Supreme Court said the previous ones weren't legal. This is according to Bloomberg Intelligence. The International Trade Court will likely find the new ones to be lawful. Let's go to Bloomberg Intelligence consumer industrials litigation analyst Holly Froome. Holly, thanks for joining us today. So the American states say the new tariffs are not legal, but under what argument? What are they saying?
So they're arguing several things. One argument they make is that they say that under a floating exchange rate system, which we have today, as opposed to a fixed rate system, there can never be a balance of payments deficit. And that's the point of Section 122. 122 is used if there's a balance of payments deficit. It allows the president to impose tariffs of up to 15% for 150 days. So he imposed tariffs at a 10% rate for 150 days. But they're saying that there can never be a balance of payments deficit in a floating exchange rate system, as opposed to a fixed rate system where the dollar is pegged to gold. There could be a situation where there wouldn't be enough gold to exchange for dollars. But in a fixed rate system, in a floating rate system, the dollar fluctuates, so that wouldn't happen. And the other thing they say is that he didn't consider other core components. So trade deficit is one component of a balance of payments deficit, but there are other components like foreign investments in this country and services that we provide to other countries. So if he considered all of those things, there would actually be a surplus. So that's another thing that they argue. And finally, they say that some of the exceptions that the president gave to certain countries that have trade agreements or certain goods that are already subject to tariffs violates the non-discriminatory treatment provision in the statute.
Okay, so you are estimating that the court will likely find the new tariffs under Section 122 legal. What follows that argument? On what are you basing that?
Well, for one thing, I think that the court will find that a trade deficit could be a balance of payments deficit. And the reason why I think that is because when the court was considering the reciprocal tariffs, which you mentioned were struck down by the Supreme Court in February, when this court that's going to hear this dispute was considering that, they said that a trade deficit could be a type of balance of payments deficit and suggested, I think heavily suggested, that this is statute he should have used to address a trade deficit. And I also think that they're going to give the president deference with regard to his findings, his factual finding that the trade deficit constitutes a balance of payments deficit. And then finally, the statute allows for exceptions. And with regard to their argument that there can never be a balance of payments deficit in a floating exchange rate system. This statute was enacted after the floating exchange rate system was adopted. So it would mean that Congress enacted a statute that can never be used, and that doesn't seem to make sense to me.
All right, Holly Froome, got to leave it there, but appreciate you joining us. Holly is with Bloomberg Intelligence. So the energy sector has been seeing big gains, of course, with that conflict in the Middle East. But my next guest is downgrading Advantage Energy, citing constraints in the gas market. Let's go to Tarek Saad. He's analyst at BMO Capital Markets. Tarek, thanks for joining us. What more prompted this downgrade for you?
Yeah, thanks for having me. So like you said, we downgraded Advantage this morning, and this is purely a macro commodity related call, not an operational one. We actually view the company as being a strong operator. They have, consistently posted the strongest gas wells in the Alberta Montney, which has translated into very desirable capital efficiency. That said, 85% of their volumes are gas, with the majority of those flowing into Western Canadian hubs. So as a result, they're the most exposed Canadian gas producer to AECO prices, which hasn't really been a desirable market, and we can see further near-term stress going forward. So on that front, Western Canada's storage for gas has exited the winter at elevated levels, even higher than 2024 levels, despite LNG Canada running generally well over that time. And we see further pain over the near term, and this really comes down to the U.S. Pacific storage situation. So the U.S. Pacific is a major export market for Canadian gas, but storage levels have exited the winter at record seasonal highs by, quite a material amount. And in March, we saw a large drop in Western Canadian flows to that market, and we believe flows will continue to be constrained as the need to fill storage throughout the summer is much lower than prior years. So we suspect this would result in gas backing up into Canada and could put material downward pressure on AECO over the summer months, with Advantage being the most exposed to that dynamic.
Okay, let's talk about your summer forecast for the price of gas, because it sounds like maybe gas would stay a little bit more level as a result of having too much around.
Yeah. Like, I think the main problem which has existed within the basin for years is the oversupply dynamic. We've seen volumes grow quite materially year over year and really surpassing, how much the export level. And the process was LNG Canada should help clear out this glut. But at the same time, the partners through LNG Canada are now overproducing relative to their liquefaction needs. So net, it really hasn't created that much of an impact. And, we've seen production grow into 2026. And, for the year over year, we're kind of seeing growth. We're forecasting growth of about 750 to 800 million cubic feet a day. So, if this U.S. Pacific dynamic continues, and even though LNG Canada ramps up to full rates, we could be in a situation where we're back to full by as we enter the winter for 26, 27.
You mentioned the company has higher costs the first half of the year. Why is that?
They just have a big capital program. They're bringing on a new gas plant. They have a turnaround at their major Glacier facility. So all of that should be wrapped up at the beginning of the by mid-year. And then, there should be a stronger free cash flow generation point, pricing aside, in the back half as, they fill that incremental capacity they have at their gas plant and, price and capital spending falls off.
So what is their production forecast for the year?
So right now, they're probably going to do about 80 this quarter. We're thinking, kind of mid-70s next quarter. And then the ramp in the back half should be about 90. So, there's about 10,000 a day that they're going to bring online in the back half of the year. That said, past that point, all their gas plant and all their will be filled. There's not a lot of incremental capacity. So it will require them to build a new gas plant to grow volumes past 90,000 a day point. And realistically, basin dynamics probably don't support this, and we don't see the company going forward with another infrastructure expansion until, supply-demand dynamics improve.
All right, I'm going to leave it there. Tarek Zad, appreciate you joining us, sir. Thank you.
No problem. Thank you for having me.
Coming up, where to invest as a war-driven oil spike and tech sell-off leaves investors nowhere to hide. Back in a moment. Time now for the ETF report. The oil price spike and concerns about the sustainability of the AI boom are forcing investors into select ETFs. Valerie Grimba is the director of global ETF strategy, RBC Capital Markets, and she joined us on this.
So you are structuring a series of notes within the ETF that limit your downside to a certain level, but of course you're probably trading off some upside to provide that buffer or that outcome period to the downside. And so I would say that these are kind of coming back into the zeitgeist right now because there's escalating conflict. This harkens back to 2022. This is a period when we saw the stock and bond inverse correlation break down. So 2022, of course, stocks were down, bonds were down. We saw that happen in March 2026, so most recently. And I think investors or asset allocators are looking at other alternatives to kind of solve for that solution in their portfolios.
And does this one give you a play on the stock market?
Yes, these buffered funds are built around the S&P 500, so they're going to be setting certain levels on the U.S. equity market. But again, it's kind of about capital preservation and looking at other ways to kind of offset or diversify within a portfolio.
Right, but there can be a cost. You are giving up potential upside.
Absolutely, there is a trade-off. But again, if you're looking at a certain sleeve of your portfolio that you kind of want some conservative outlook or capital preservation, these look very interesting, especially if bonds are falling as well as stocks.
Here's another one, BALT, the Innovator Defined Wealth Shield. And the idea here is to protect against a situation, perhaps inflation, in which stocks and bonds are dropping together.
Exactly, and this is the large U.S. one, and I often use this one as reference because the ticker is excellent, BALT, stands for bond alternative, B alternative. So again, if you're looking for something in your portfolio for that conservative allocation, or if you think we're going to go into an extended period of market weakness, this ETF is designed to kind of hedge against that.
Asset allocation ETFs are popular. You guys, you've got a big ETF family. Easy is one from RBC, and then King, KNGG. Remind us how these work, please.
Yeah, so Easy is brought to you by Evolve ETFs.
Oh, I'm sorry.
But we help launch it, and we're the designated broker on the fund.
Okay,
so we're trading the lead market maker.
But it's not an RBC product.
Correct. It's
as
Evolve
such.
ETFs. Yeah.
Sorry, Carrie.
That's all right.
Go ahead.
Yeah, so we're seeing, kind of the all-in-one ETF solution has really taken off here in Canada. Investors are really clamoring for this. This really is the easy button, the kind of set it and forget it. And these are ETFs of ETFs. So the idea is it's a single ticket solution, but you get access to a variety of underlying ETFs. So Easy is, again, kind of a generating yield play, and it owns a variety of different Evolve ETFs in the Easy ticker. And then KNGG is brought to you by Brompton Funds. And same thing, it's holding 3 different existing ETFs within the one ticket solution.
Have you had pushback from clients on these enhanced yield ETFs? Because in quite a few cases I've noticed they've underperformed the straightforward stock index.
It really just depends what the end investor is looking for. Again, I don't think any of these solutions are inherently good or bad. It's just solving a problem and meeting an end investor's needs. And so I think the Canadian investor is telling ETF issuers that there still is a strong demand for yield, and that is a very much focus. And so these enhanced yield products provide that to the end client.
I guess my bias would be, though, just owning straight stock ETFs and just liquidating some of it every month or every quarter for income, but each to their own, I suppose.
Yeah, but then you just kind of described the digital friction points. You have to be diligent about doing that, have the wherewithal to do that, and do it on a regular cadence to kind of keep that. But an ETF can kind of solve for a lot of those problems for you, and it's less to do, really.
Okay. And then finally, an idea in energy, HOU, the beta crude oil inverse XX leverage. So this is a play on oil prices dropping.
Correct.
But is this one of these that you really should think about trading on a very short period?
Yes, this is definitely for the sporty or athletic trader. You're only going to be using this intraday, really holding this maybe 1 or 2 days maximum. I highlighted it because trading volume is through the roof. On HOD, this is the most traded Canadian listed ETF.
Oh, this is a bull one, is it?
HOU is up 2x the upside, and HOD is to the downside.
Oh, I think I said inverse. So this is the bullish one.
This is the bullish one, maybe on screen, but HOD to the downside. Obviously, traders or people are trying to position. They think this oil price is looking too frothy right here, and it owns the front month contracts. It's been a tough trade. It's traded, the volume is up a lot, but I mean, obviously, we've seen sticky oil prices. So, yes, you're better off owning the HOU right now.
Valerie Grimba is the Director of Global ETF Strategy at RBC Capital Markets. Coming up, Hot Picks. We'll look at 3 stock picks in travel and leisure, including one player on the high seas. Back in a moment. Time now for Hot Picks, and we kick things off with the cruise company Carnival. For more, we're joined by James Hardiman, analyst, U.S. leisure and travel at Citi.
I think more near term, this is an industry and a company that's gotten hit hard as a result of the Middle East conflict. And I think that's for 2 reasons. One is the cost side, right? Fuel is one of the biggest, if not the biggest, expense line item for cruise companies. And Carnival in particular is unhedged, and so they've gotten beaten up because of that. And then 2 is the demand side, right? The belief that travel is going to be negatively impacted by the Mideast violence, right? And so obviously we're still wading through the first. Certainly on a day like today, it's hard to feel like we've found a ceiling in terms of fuel prices. The latter has been really good. Demand has been really strong. As a matter of fact, they raised their top line guidance when they reported a week and a half ago. And then on top of that, it's a great capital return story. They've now laid out about, $14 billion of shareholder returns between buybacks and dividends that they're going to pay out over the next few years. And they've just opened a new private island, Celebration Key. 2026 will be the first full year of that benefit. And so I think if we can sort of take a step back and think that some of the Middle East conflict will eventually subside, everything else is going exceedingly well for this company. And, those higher fuel prices are already factored into numbers at this point. I think there's a lot of reasons to believe that the future is bright for a company like Carnival.
Right. You probably heard the old joke, a boat makes you happy on only 2 days, the day you buy it and the day you sell it. They are expensive to run. But anyway, you like the look of Brunswick, a big seller of marine recreation products.
I do. And I think it's been a rough, 3 or 4 years for the company. I think the combination of inflationary boat prices and then higher for longer interest rate has really hurt this company. We went into 2025 thinking that, we could finally see a rebound. And it seemed like it was heading that way. And then Liberation Day happened. And I think that had a pretty negative effect on demand. Second quarter was down double digits in terms of retail. What we've seen since second half of last year flattened out. First quarter of this year, we've started to see some growth. We think sort of mid-single digit growth in the first quarter. Then we'll get to lap the Liberation Day fall off. Certainly, if we can get to mid-year with some decent growth during the first half, I think there's meaningful upside to numbers. And that's ultimately what I think you're playing for, is that we've finally seen that bottom that we've been waiting for years to see.
And then finally, DraftKings, a big player in sports betting.
Yeah. So, online gambling and specifically online sports betting is very much a growth industry. And I think DraftKings is one of the, 2 companies on earth best equipped to capitalize on that. What's gotten lost, I think, over the last 6 to 9 months is, prediction markets have really been in the headlines, right? And the bear case is that prediction market players like Kalshi and Polymarket are going to take all the business or most of the business from the traditional online sports books, right? DraftKings and FanDuel. The bull case is that the online sports books are superior in terms of their offerings. And so those prediction markets are never really going to make too much progress. Our thesis is a bit more nuanced. We think there's going to be some cannibalization in those existing markets, which make up, call it 60% of the U.S. population, but that there's a bigger opportunity to be gained from these prediction markets in the unregulated states, right? 40% of the U.S. population still doesn't have access to online sports betting. And this is, in a lot of ways, a Trojan horse into those markets. So we think it's a big opportunity. There's a lot of legal challenges brewing, which is a whole other subplot here. But we think these companies have positioned themselves in either scenario, whether there's prediction markets, whether those are legal or not, to really be successful.
It's amazing, isn't it, James? We're almost out of time, but this explosion of gambling, prediction markets, you name it. Yeah. And there are worries about social harm here. I know I'm getting a bit off topic, but some people are overdoing it, apparently.
Yeah, people are overdoing it. And I think these prediction markets in particular are it's early days and they're unregulated, right? And we've spent years, decades trying to sort of make sure that the proper guardrails surround traditional gambling and online sports betting. Well, now you've got this whole new product, which, for all intents and purposes is gambling, and there really aren't those rules around it. And so I do think there's a lot of work there that needs to be done to make sure that this is safe for the public.
All right, that was James Hardiman with Citi. Let's take a final look at how we ended the day today on the North American markets. The TSX gaining 55 points today, so 0.2%. The S&P 500, not a material gain today, but did end in the green. And the NASDAQ, a 21-point gain on the day, 0.1%. We also do want to check on West Texas Intermediate. Oil prices have been fluctuating with this new final threat from Donald Trump. WTI, the May contract, down $1.87, and after hours, the price $110.50 thereabouts. Know your options also coming back tomorrow at 3 p.m. Have your options trading questions answered by Chris Tom of Moat Financial. Thanks for joining us today for The Close. We'll see you back here tomorrow.